Hello. I don't think anyone could deny that these are strange and challenging times indeed. So much so that I can't work from my normal studio. So, for the next few videos, I hope you'll forgive me not appearing all the way through. That may be a bonus, as much as a drawback, but you'll get my audio and you'll get my normal slides, plus a contact point where you can raise any questions. I hope you still enjoy the videos, and once we're through this crisis, I look forward to rejoining you from the usual spot. Welcome to the Skillick Explains video. This week I want to take on a topic that I've actually taken on before but is really important right now, probably as important as it's ever been, and that is why stock markets and economies often seem to diverge, and we've seen huge examples of this recently, probably the biggest divergence some people will ever have seen in some ways. So the background to this would be what? Well, essentially there is an old quote that says the stock market is not the economy, and over the long term the two in some way have to track each other. I mean, stocks represent the performance in theory of companies, the profitability of companies in the economy. So the two can't be completely out of sync. And yet recently we've seen a lot of evidence of exactly that. So how can the two be so different in the short term, and how do investors interpret that? Well, let's take a look at a recent example of exactly what I'm talking about. So on the day that the latest advanced estimate, and it is an estimate, of US GDP was revealed, it showed a 4.8% drop. And 4.8% is a massive decline in the wealth being generated by the biggest economy in the world, in the US. That is hugely significant. Yet, the S&P 500, that is the index that represents the leading stocks in the American market, rose just over 3%. So hang on a minute, GDP down 4.8%, a colossal drop, and that's an estimate. When the actual number is revealed, if you like, it could be worse than that, yet the market putting in what by any accounts on the day is a strong performance of just over 3% up. And if you look wider, so step back a bit, April as a whole was a terrible month for data, but a really strong one for stocks. So what's going on? So, three key factors I think are at play here potentially. Stock markets look ahead and price in future expectations, and we'll come back to that in a moment. Central banks have declared huge amounts of stimulus, and governments have come in alongside them with some fiscal measures which we've rarely seen on this scale before, if ever. And there's a sentiment factor at play. Going into this, people said this time is different. There are things about the economy that make it potentially able to bounce back quicker perhaps than it has in the past. And a lot of that is reflected in the stock market. Now, the jam tomorrow argument. So how does this work exactly? Well, stock prices reflect where investors think firms will be, not where they are right now. So you've got that fundamental difference. Whilst the actual economic data coming out is a reflection of where we are now, or an estimate of where we are now, stock prices are not. They price in where investors think we will be. So, the bull market argument, if you like, the justification for stocks rising would say, well, stocks overreacted when the virus struck. People panicked, herd mentality took over, and some sort of price recovery was therefore inevitable. And on top of that, you get technical factors that can magnify short-term stock market bounces. You get people who've bet on prices falling, short sellers closing out positions, and without going into the detail, that effectively magnifies any bounce. So there were people looking at the charts saying after such a colossal dip at the start of this crisis, some sort of recovery was inevitable, because just as there is irrational exuberance on the upside, there was too much pessimism on the downside. So there's one factor that stock market analysts would say makes it reasonable that stock prices recovered even as bad economic data was still coming through, based on the fact stock markets look ahead. Then you've got the massive intervention going on. We've never seen anything quite like this. So corporate investment has plunged, companies have stopped spending money, household savings are spiking as consumers rein in spending. It's very difficult to spend during lockdown other than on essentials, and dividends from large income companies are diving. So those are all negative factors, and yet governments have intervened along with central banks on a new scale and in new ways. This hasn't just been monetary stimulus, the old quantitative easing, interest rate cuts. There's been fiscal stimulus on top, everything from furloughing of employees to support for small businesses and so on. And depending on which numbers you read, if you look at the data, in 2020 there was $3.7 trillion worth of stimulus, and that, you could say, matches 3/4 of 2019's entire net investment plus saving plus dividends. So The intervention's so massive, some would say it's gone a long way to offsetting all of the retrenchment you'd see elsewhere in the economy. Then you've got the new economic paradigm argument. This time is different, and that's why we're going to come out of this quicker than perhaps some people think. So that says technology has changed the way businesses work. Massive technological disruption, flexible staffing, if you like, not so much of a need for central premises and so on. So the economy has been changed by automation, AI and so on. And actually tech stocks have had a relatively good, inverted commas, crisis so far. Government stimulus will save jobs and incomes. So in other words, what's happening here is you've got technology changing the workplace. A lot of people have been able to scatter, goes the argument, and work from home successfully. Government stimulus will support jobs and incomes. In other words, demand from those people who've been furloughed is being deferred, not destroyed. And hopes of a V-shape, a rapid V-shape recovery, have therefore not yet been dashed. Now, summing up. So where does this leave us, basically? In summary, no one actually knows how this will play out, and that's important. If you're reading the headlines, no one knows whether we're going to get a V-shape, as they call it, that's a rapid dip and a rapid recovery, more of a U-shape, a slow, drawn-out dip, and a long recovery, a hockey stick, that's people saying we dropped quickly, everything went wrong quickly, and it will be a gradual recovery from here, or even a W. And a W is the double dip. That's where things look better for a while, and then something catches us out. And that something could be returning inflation. It could be these government support measures not being as effective as people thought. It could be the underlying damage to businesses being greater than the stock market has priced in, if you like. Technological change and stimulus can't fully support confidence and demand. That's important. Yes, the economy is different to what it was 10, 20, 50 years ago, but bear in mind, we do need confidence to return at some point. We do need demand to return at some point. Businesses need to start selling again. And the future ramifications of this unprecedented stimulus are unclear. Maybe governments have done enough, almost for the first time in history, to completely see off the main effects of a recession, or maybe they haven't. Maybe they've cushioned the blow, but ultimately the blow is still coming. Any questions? editor@killick.com. And if you'd like to watch related videos, it's killick.com/learn.